So thanks everyone for this call today. My name is Aditya Chopra, and I'm the founder and CEO of AKC Capital. We are a boutique wealth management firm based out of India. And what we are doing today is we will be, walking you through the GIFT City IFSC in India infrastructure and the nuances, right? The latter part of the call, I would have my colleague, Mr. Siddharth Bothra from Ambit Asset Management, talking about the fund strategy in the current markets. And then we would like to kind of open this for Q&A for a larger audience, right? So that's the overall architecture. So thanks again for everyone. So I'm sure everyone has, been talking about the GIFT City IFSC in India. So first, what we'd like to talk about, why the GIFT City route for, global investments. And the first thing which we see is that this gives you access to global markets, right? So for all foreign citizens, NRI clients, this basically allows investors to diversify their portfolios with international assets, which may not be otherwise readily accessible through traditional Indian investment channels, right? So access to global markets becomes a key point why investors globally look at the GIFT City route in India. The other attribute which we see, which the government is trying to promote through this route is really the tax benefits piece, right? And tax benefits would include various tax incentives. These include exemptions on capital gains, STT, securities transaction tax, and the GST as well. Obviously, the end of the day, the tax nuances would be a function of your domicile, but it's important that this structure gives you considerable tax concessions when you're making your global investments, especially out of India. The third piece which we wanted to highlight is obviously in terms of how do you handle the regulatory processes as well. So this entire structure gives you a very simplified regulatory process. It's making repatriation easy, seamless for greater control and asset allocation without any operational constraints, right? So obviously, as you see that, it becomes very easy from a regulatory standpoint also, where the government has ensured that the clients who are outside India can make seamless global investments in the Indian capital markets. And which is pertinent to the next point is that the entire structure has been kind of created with one single regulatory interface, which is nothing but the IFSCA, which in this mechanism within the GIFT City avatar kind of gives you, combined powers of all the top four financial regulators in India, which includes the RBI, the Reserve Bank, the SEBI, RTI, and the PFRDA, right? And under 15 central statutes. So essentially, this is a key component of the government's endeavor to make sure that all the regulatory nuances are kind of vested in a single body. So from a client perspective, when you're coming to this piece and making your global allocations, it makes the process much easier and simplified, right? So it brings me to the next slide. Continuing with the benefits which a GIFT City would bring you, IFSC, right? Currency and bank account is a question we come across a lot among our clients in India and overseas. So here, I guess, you could make investments in any global currency, and this can be converted into USD by the SWIFT system through the investor's offshore bank accounts. And as you would see, there is no requirement for the investor to open a separate account in GIFT City. I think this is a very important benefit for all our viewers here who are looking at alternatives to diversify their global portfolios, right? So essentially what we're trying to say here is that you could actually kind of invest in Indian markets through the structure, virtually through any bank account in the world globally, and also repatriate the funds back into any other bank account, right? So this gives you the seamless flow of funds when you're looking at your global allocations and diversify your portfolio across uh, emerging markets and developed markets as well. Um, uh, uh, and the other point which we've kind of looked at when we look at the structure is your FPI license and PAN. So the good part is that for retail high net worth clients, obviously today as we speak, the entry barrier to invest earlier was around $150,000. As the market opens up, you're also seeing this entry barrier going down significantly. So we are seeing a lot of funds which would eventually be, coming out with more flexible ticket sizes. But that's a endeavor in which you to have a higher participation. So you actually don't need a PAN in India to apply under this architecture, right? So we understand that it could be an NRI or foreign nationals. You really don't need a PAN card to apply. So obviously the documents checklist will be more on your international documents across passport or any IDs which are actually issued by the country of domicile in which you are based. And so I think that's a significant kind of leeway which you get when you're making these allocations. And which brings us to the next point is that one question which I come across all my clients and we across to our global clients is how do you really look at the complexities of income tax return, right? So obviously, broadly, as you see that in case of NRI investors who don't have earnings, income other than income from investment in the fund, you're not required actually to file income tax return in India. Predominantly, you will be guided by your country of residence where you're staying in line with the tax laws of your base country or country of domicile. So if you don't have any income coming from any of your assets in India, it's pretty much, you don't have any tax obligations. And like I said in the previous part, the government is really not tracking your PAN to kind of to see, how much of investments are there. So it's a pretty seamless structure where the government is wanting for higher, retail participation coming from overseas investors and eventually boost dollar as well, dollar inflows into the country. And I think my next point, which I wanted to highlight here, is really about the demat account. For all our viewers here, I think this could be an interesting part because, as you were aware, under Indian laws, when you are investing in an AI structure, alternate investment funds, it is mandatory by SEBI to have a demat. But in this structure, there is no requirement to open a demat account in IFSC GIFT City, and yet investors will have access to Indian listed equity markets. So I think this makes it much more easier vis-a-vis other ways in which you were to come without a GIFT City and come and invest in India. You do need to have a demat account as an NRI client to whether you're making investment in alternate investment funds or portfolio management services. So I guess this is a very, very significant concession and a removal of a bottleneck that you don't need a demat account when you're investing in the GIFT City IFSC in Gujarat. So, which brings us to the next steps in terms of how obviously Siddharth would be walking us later to the latter part of the conversation, but typically Ambit Asset Management, which would be looking at the fund structure. This is a more representational in nature, but typically, as you can see on my right side, you have global investors who are outside India. You have an IFSC AIF, and we'll be walking through in the latter part in detail, but typically the investors are putting money directly into the AIF, which is registered under GIFT City IFSC. And through that, you are investing in Indian listed companies. And obviously, as you can see on the left side of the screen, you would have your investment advisors based out of GIFT City, which is Ambit Investment Advisors in this case. So this is more of a representational slide, but would hold true across structures broadly in this avatar, right? Um, Obviously, a pertinent question which may come to you is when you look at these concessions, the benefits, how do you really look at the fund flow coming in these markets? I think what we worked on in a slide here is a very representational slide where, as an investor, you are based out of India. Globally, anywhere in the world, you're an NRI or a foreign investor. These are the two categories, right? So what you see exactly, the red line is your inflow coming from overseas into the gift city. You have an IFSC AIF, which is a USD account. It kind of moves into the Nostro account, where the money is converted for investment, and eventually into the INR account, and it flows into Indian equities. And typically, when as a client you are redeeming the fund after the shelf life, right? It pretty much follows the same different structure in which you see the funds going back via the same architecture back to the overseas bank account of the investor. So I think it's a very seamless process in terms of fund flow. Obviously, you need to be cognizant about the underlying fund strategies, whether they invest, which would be a different function. But broadly, what this slide is trying to tell is what would be the fund flow when you're investing into a structure which is registered on GIFT City IFSC, and this is an AIF in this case. It pretty much explains you the fund flow. So as you can see, this is pretty simple and easier for investors to track the investments, and eventually not only to make the investments, but to get them back when they're redeeming the funds as well. We broadly talked about tax implications. Broadly, this is just a very representational slide. I'll just give you very broad level, guidance there. I think we covered tax part in the earlier scenario. I think at the thumb rule, obviously, you would be kind of guided onto your tax by the domicile of the country you are based in. Like I said earlier, if you don't have income from India, then pretty much you don't have to bother about paying taxes in India, but which we covered in the previous slide. But eventually, depending on the underlying, obviously in this case, we've talked about an AIF. There could be other structures where the underlying could be a mutual fund or a PMS architecture. Your tax implications would vary, right? Typically in mutual funds, it's a pass through, so you really don't get any kind of a tax implication out there. But when you look at other structures in PMS where there's actually transfer of securities, there could be components which would be coming under LTCG and STCG. So I guess LTCG in India is pretty much at 12.5% beyond 1 year. STCG, as you know, with the new tax laws, is at 20%. So again, it's a function of the underlying, but broadly, you would be guided by the tax laws of the country of your residence or domicile, right? Which brings me to the next slide. I think that was a quick overview for the time that we have, and we are like 12 minutes into this conversation. Now, what I would like to do is I would like to give the floor to Mr. Siddharth Bothra. He's the Executive Director and Fund Manager at Ambit Asset Management. And he comes with more than 2 decades of experience in the fund management space, with a long stint with Motilal Oswal in his earlier roles. So he's going to talk about the strategy in the current markets. So over to Siddharth to take it forward from here.
Thanks so much. Good afternoon, everyone. I'm delighted to get this opportunity to discuss about our new AIF on the GIFT City side. And as they mentioned, maybe I'll just start off with a very brief discussion on why look at this kind of a fund today. The key reason I believe what's happening is, if you look at the markets from say FY21 post COVID till I would say even September 24, or even till the first half of this year, this was a period which was very different from a normal kind of a market where it was a very high risk on high beta market. And in these kind of markets, what happens is that typically the market becomes very broad based. There's a rush towards more high beta stocks. There's a rush towards more retail led kind of a market. And the market post that, once the market gets back into sanity and all, you typically see a period where a lot of these strategies which were built around the time in the last 3 4 years, they starts faltering. Volatility starts increasing. Drawdown becomes an issue. The drawdown, when I say it becomes an issue, means drawdown which has typically been very limited in the last few years can give you surprises. And during these times, the market moves more towards 101 of investing, that is, get into the basic of investing, buy quality companies, buy companies with a long term view, good management. And from that perspective, our fund is more focused on long-term investors who think more in terms of owning businesses rather than owning stocks. These are investors who have larger net worth. Their first focus is on preserving their capital. The focus is on it's not that they don't have a strong return expectation, but their return expectations are more long term in nature and more aggressive, in the sense that typically these would be the kind of investors who would think about how they can multiply their money 7x to 10x in 10 years, or think in longer term perspective as to how in 20 years can they make their money more into like a 40x to 70 80x, which is essentially get a compounding between 20% to 24%, 25%. And we believe this is a fund which is aimed at meeting some of these requirements. The second part is that we always believe in maintaining a prudent mix of offense and defense, in the sense that when there's a war, when there's negativity, it's not that we become too defensive, nor do we like lose our focus when things look very when the market outlook looks very rosy. So in the sense, we maintain that right mix, because if you're too defensive or if you get too scared of market as such, then you can't achieve your long-term objective of being in the market when things are really difficult and getting long-term returns. At the same times, if you get carried away during rosy times, one black swan event can take you back significantly. The third is that we are very growth focused. The whole idea about this fund is to buy 2025 of what you call forever companies, which is a mix across the life cycle of corporate, from high growth to young growth companies to mature companies and some mature stable companies. So the portfolio should have stability from some very companies which have very deeply moated with lot of longevity, and at the same time should have enough companies with high growth, which would give it that excess Z factor that you look for in a fund. And lastly, the key way by which we hope to deliver the alpha is by focusing on removing the behavioral bias and the institutional imperatives, which is prevalent across most funds today. Yes. So if you can move on to the next slide, opportunity. Next one, yes. So if you look at the reason for this fund today, like one of the other reason is that this kind of a portfolio could be an antidote for the emerging global macro challenges. If you look at, we had written this long before this tariff issue, but it seems that globalization and the low interest rate, which is the first 2 points, which have been one of the tailwinds for the equity markets for the last, say, I would say 2 to 3 decades now, almost like 30 35 years, is something which looks like may not act as a tailwind anymore and could increasingly start becoming a headwind. In the sense, globalization was the reason because of which inflation had been falling for a long time, because the countries were focusing more on what they are strong in and trying to depend on other countries for what they are not so strong in, which is a typical 101 of economics. But with what we have seen happening in the last 2 years, you could argue that this Trump issue is more a near-term, short-term. But these things will not leave the mind space of most people. And even if these things, even if what Trump has led to get sorted out in the next 3 to 6 months, which is one expectation that investors have, that a lot of these tariff related issue was a one time thing which he created to get countries in line, and it will get sorted out soon. Even if that happens, I think globalization as it stood may not be there anymore. And if that is not so, then it would have impact on inflation. Then inflation benign, the US as the reserve currency, that could also be under attack. And with disruptions increasing, AI increasing, investing will become increasingly challenging. You would need quality companies, you would need companies with longevity. Otherwise, the high returns that you've seen in equity markets over the last few years, with the exception of COVID year, could be something which could get challenged. Already in this 1 year, you see the 1 year returns are pretty muted or negative in many indices. So we do see that the next few years could be a period of low returns and higher volatility, which could be challenging. And you need to have be currently correctly positioned to navigate this period. And lastly, we think India stands out in this kind of environment because India still remains a very bottom-up market, and inherently the low per capita income, high population. So growth as such will not be as much as a challenge because as the working cap population keeps increasing, and also the fact that a lot of these segments are very, for India, the large part of the economy is still very domestic oriented. So I think India inherently will withstand the next 2 3 years better. Next. So coming to how is our, the next, how is pricing progress? How is this fund different? The first point, we have 5 reasons by which we think because of which this fund is differentiated. The first being the mindset, the process, the approach, the risk positioning, and the behavioral aspect. And starting off with, some of these things, like the most important one being that if your goal is to achieve the magic of compounding and compound your capital over a longish period of 5 10 years, the first thing you need is to remove factors which impede that compounding. And to our mind, the number one is mindset, which is a very short term mindset which is prevalent in the markets today. Very few people think in terms of next decade. Most are more focused on next quarter. There is a very high focus on stock price movement versus business fundamentals. Again, a very high premium given to action. The moment there's a war, people want you to go deeply into cash. The moment things look rosy, they want you to, be significantly high on some of the high beta stocks. The comfort of crowd is becoming increasingly in this new environment of, more media presence, more knowledge dissemination. Everyone wants to be around where there's a comfort of crowd. So independent thinking is becoming scarce. Asset gathering and alpha versus relative performance and absolute performance. I think market is in a state where if you start focusing more on absolute performance over the next 2 3 years, your performance could actually be better than if you're very relative focused. Because the reason I'm saying is that whenever you look at markets which is at a transition or at one of those pivot points, whether it be 2008 2001 or whether it be 93 94, these were period where you saw excesses happen over 4 5 years. And when that pivots, if the focus was on relative, you would continue to be more indexed in what worked in the last 3 years, rather than looking at with open mind and seeing where is the opportunity and what would do better for me over the next 3 years. So I'll try and discuss each of these points a little bit more in detail. Next, please. Yeah. Next. So one of the things is that if we are trying to focus on benefiting from the magic of compounding, you have to buy growth companies. And within growth companies, our preference is more for companies which have longevity of growth rather than short-term high growth. The short-term high growth is basically typically a trap where you end up losing a lot of money, because that's something which can suddenly surprise you, and is also something where often the misvaluation, valuation mismatch could be huge. So this fund, we typically are more focused on looking for companies where we can find longevity of growth. Next. I'll spend if you go up, I'll just spend a moment reading this quote. Now I come to my process, which is how we invest, which is the pursuit of pricing power plays. So I'll start with this quote by Warren Buffett, which says that the single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you have very good business. You have a very good business. In the sense, the what we are trying to do is the very essence of what Warren Buffett has been practicing for the longest time. I'll try and discuss about our process more in detail in the following slides. Next, please. So what we essentially look for, maybe first let me just explain what we mean by pricing power. Pricing power is nothing but a company's ability to raise prices and maintain the profit margins amidst increasing cost, high competition, or maybe near-term disruptions which are there. So typically, when you think in terms of pricing power, there can be two key variables. One is you find companies which are following the cost advantage strategy. These would be companies like Interglobe, which is Indigo, or companies like DMart, which would be Avenue Supermart, or companies which are more focused on bringing down their per unit cost significantly below the industry average. So if you see the line here, this is the industry average, and these are companies which operate significantly below the industry cost average, because of which they have a significant pricing power. The other would be companies which are focused on increasing your willingness to pay or trying to create higher buyer surplus. So, if in any industry the average selling price is, say, this yellow line, they try and have so much pricing power that they can price their product significantly higher. So these are the two kind of ways by which companies with pricing power operate in, and where we try to find them. In very rare cases, you come across companies which actually enjoy both end, which is not only do they have a cost advantage, but also the price advantage. So one of the companies that we currently feel is enjoying that is Zomato, which is eternal and is one of the larger holdings that we have in our portfolio. Next slide, please. So firstly, why pursue pricing power plays? Can you go to the next slide? I'll start off maybe from there. So let me start from this. Our aim is to create the Lollapalooza effect in a portfolio over a long-term basis. And everyone knows about Lollapalooza because it's one of the term which has been talked about a lot by Charlie Munger. But let me just read the first line of his definition for Lollapalooza, which says that the Lollapalooza effect in business is about getting multiple mutually reinforcing factors right. So two words here, which is getting multiple and mutually reinforcing factors right. The same way we believe that in investing, there are many ways by which you can do quality investing. You can look for companies which have dominant, who are leaders, who have dominant franchise. You could look for companies which have multiple modes. You could look for companies which have some superior quality, but we have found that we have a proprietary screening model where what we do is essentially just look for companies where this second point is there, and then look for all the factors and see if these are also there. The second factor is nothing, but we go looking after company by company and sector by sector and ask two simple questions. That what are the key consumer variables in that particular industry or a company, and if there is a huge variance in that. What I mean by that is that, say, assuming you're looking at an airline industry, you ask that what are the two, three things that the consumers weigh very highly. And, obviously the question answers would be something like cost would be number one. Number two would be the network. Number three would be how timely, how efficiently is the airline run, how quickly or timely you can reach from place A to B. And you will find that on all these factors, which weigh very heavily for consumers, there's a huge variance. That is, there are many players who are really weak, and there's one or two players who are very strong. In case of aviation industry, all the weak players are now bankrupt and have gone out of business, and it's almost become with 65%, and the other is with Air India and little bit SpiceJet and so on. So in a way, the industry for the longest time has been operating as a 100% profit monopoly for Indigo, though their market share remains around 63, 65%. So we look for companies which have all these factors, because that's when we believe a company starts having pricing power. And our idea is to buy 20, 25 companies which have pricing power. And we believe that, if you take a long-term perspective on these companies, that's when you will create the Lollapalooza effect in your portfolio. I'll again try and explain what essentially we are betting on. When you buy companies like this over a 5 year, what happens is that in a drawdown, because these are very high quality companies, companies with a lot of moats, longevity, they fall much less than the average market. So, you benefit in a drawdown by having superior performance versus the market. And over a 5 year period, what happens is the bet is that when you buy a quality companies of 2025, one, two out of them will you give you that outsized return, which will bring in that zinc factor in the portfolio. Like for us, in the last 2 years, the stocks which have worked very well, one is say Eternal, one is KFin, one is Bharti, and so on. So combination of these two things, which is a very low drawdowns, and few factors, few companies taking your overall performance significantly high, is how we believe over a 5 year, 10 year period, we can create that 4-5% alpha over and above the index is our goal. If you go to the previous slide, I'll just spend a minute here. Many people ask, okay, why pursue pricing power plays? So number one is they act as great inflation hedge because they preserve the real earnings and shield investors from the eroding effect of rising cost. The number two is typically if you are able to find pricing power companies in a when they are exhibiting it or in the process of exhibiting it, these are companies with not only see the top line growth, but they also see margin lever working for them. Their margins also keep expanding because what happens is that when you grow high, most of the operating leverage, if you have pricing power, you're able to absorb yourself instead of passing on to the investors. So you benefit from two things. You benefit from strong growth or steady long term growth. You benefit from margin expansion, which kind of doubles down because the earnings growth then is significantly higher. The third thing is that these are typically very stable compounders. They are, they are not the glamorous companies. You don't hear much news about them. They keep, compounding on the background. The first is obviously that they are very resilient, and they do better across economic cycles and can be the cornerstone of resilient high quality portfolios. The last is that when you think in terms of what are the levers for a stock to do well, one is the top line growth, the second is the margin lever, the third is the valuation. Typically, once you recognize a company as a pricing power company, what happens is that these companies typically have low volatility, which means your WACC or the cost of capital comes down. The other is these companies have higher longevity. So the period of high growth, the number of years goes higher for these companies. And so as these companies get recognized, the valuation keeps expanding. So you benefit from all three sides, and your overall compounding is much superior than a normal company. Next slide, please. Next one. Next one. So these are the two things, while you would have many investors say that they focus on quality, these are the two factors which differentiate us from the others. The first one being that, our focus is on having a right mix of companies across the life cycle of a company, across a life cycle. So the exhibit you see on number one is nothing but a Professor Damodaran's exhibit of how just like a human being, even a company goes through different life cycles, which starts as a startup, young growth, high growth, mature, stable, and then starts declining. So a lot of the quality investors, operate largely in this gray area, which is where you find established pricing power companies, because they give a very high weightage to what's happened in the past, and sometimes are not open-minded enough to incorporate new companies, new industries which have got listed, or companies where they may have gone through difficult periods in the recent time but are now coming back much strong. We try and have companies across this entire range. And the idea is, instead of thinking in terms of small cap, large cap, mid cap, we want companies which are across this entire spectrum of life cycle. So we want companies to be there for both young growth, high growth. At the same time, we want companies in mature growth and mature stable also, because they are the ones which give stability to your portfolio. And some of these young growth, high growth companies is what brings the zinc to your overall returns. And we do it in a proportion of a bubble. So what happens is, though we do take some risk when you are buying something where growth is ahead, you are taking slightly higher risk. But we limit it to that 15-20%. So we play the bubbles theory well. And while your risks are limited to 15-20, the 80% of your portfolio gives you high stability. And on a long-term basis, because many of these growth stocks do significantly better, the very high growth, what I mean, and they boost your overall returns. The second is our focus on forward quality. We are not so much about static quality, which is being too indexed to the past and always having some kind of a screening which says that only if this happens in 5 year, 10 year, or 20 year, then look at it, and so on. We believe that markets are very dynamic. This is a age where things get disrupted fast, where quality management can make a big difference in the first 5-10 years of a company. And if you miss out on these kind of companies, if you miss out on factors where pricing power is visible from a very early stage, you would miss out on great wealth creators. So this is where we are different. We try and stay away from conventional wisdom and largely focus on our pricing power framework. And as I mentioned, our idea is to be in this sweet zone. So we avoid companies here. We also avoid companies, which are at the late stage of mature, stable, or in the declining stage. And as a result, we remain a very growth-focused investor. And when you look at typically our overall portfolio statistics, our PEG ratio would be more like 1.4, 1.5. Our earnings growth is typically 20-25% higher than the industry. Our ROE is significantly better, and in terms of ROE, we are much ahead. Yes, next. So another thing, which perhaps could come to investors' mind is that if we are buying quality companies, if we are buying pricing power company, will they outperform? Because a lot of these companies are known. So there have been so many empirical studies done which show that on a long-term basis, these companies keep outperforming. And the reason, the secret behind their outperformance is that the key thing which decides this outperformance is the longevity of growth of a high growth company, the geometric kind of a growth which happens. So whenever growth goes beyond 20-25%, the human mind is not able to comprehend it and value it properly. At the same time, the human mind typically thinks of growth in a very short duration, like okay, next 2 years, 3 years. They are not able to see these longevity plays which can grow for 10 years, 20 years, and so on. So most of the companies which have created a lot of wealth, whether it be in India, globally, these are companies which have been growing for 10, 20 years, whether it be Microsoft, whether it be Amazon, whether it be many companies in India, like whether it be Bajaj Finance, whether it be Page, whether it be iShares, and so on. So this is the reason why the focus on pricing power plays. Next. I'll just read out this, again, a quote by Warren Buffett, because we read the first one where he talks about pricing power. His second one is that our investment approach is not that of placer mining, the process of shifting through piles of sand for specks of gold. Instead, we attempt to apply our pricing power framework to find large, unrecognized nuggets of gold that sometimes lie in plain sight on the ground. So this is essentially our focus. So if you move to the next slide, a lot of investors view investing as a treasure hunt. So they go around a haystack trying to find new stocks which no one has heard of. Our investing style is very different. Most of the stocks we buy is visible in plain sight to everyone. Most, if you look at my portfolio of the portfolios, of the fund which I manage today, most of these companies you would, yourself believe that, okay, this is something which is a must buy. And these are nuggets of gold, which sometimes just needs to be picked up. So that's our investing style. And, uh, this is something which is the beauty of investing, because the more simple you make it, investing inherently is very simple. It's just that people try and make it more and more complex. Next. So I think this is a very important slide, because what it shows is that when you say pricing power, a lot of people believe that essentially what you're talking of is high longevity consumer brands, names like Titan, Nestle, maybe to some extent companies like Asian Paints and so on. And you believe that this shaded area is where you will invest in. But pricing power has many facets. In fact, the biggest opportunities are found outside this shaded area. Like there are many non-glamorous steady compounders like Crisil, Blue Star, Ultratech. Globally, if you look, companies like S&P, companies like Moody's, companies like Mastercard, companies like Visa. These are names of high quality pricing power plays, but you hardly hear of them, and they keep compounding in the background. We have similar companies in India as well, whether it's CRISIL, whether it's be some capital infrastructure plays like CDSL, KFin, NSDL, which are now getting listed. So all these companies can be non-glamorous steady compounders. There are many companies which have hidden pricing power, like HDFC, AMC, KFin. So you don't think of HDFC, AMC as a pricing power play, but just look at the stock and you realize how, as investors recognize this pricing power, how is this getting re-rated? Then many established pricing power plays, but they are very non-glamorous and work on the background, like Abbott India, Aisha Motor. They have been some of the biggest wealth creators, but very few people talk of them. The other being fallen angels like Bharti, ICICI Bank. So 5 6 years back they went through difficult periods, but they are coming back, and that should be no reason not to buy them. In fact, those should be the stocks which you should really look ahead for. And lastly, mature companies which are completely misunderstood, like Eternal, and so on. So our idea is to have a holding which is widespread across these companies, and that's how we create our long term wealth. Next. The focus on risk is the key one. There is this old saying by Howard Marks which says that they are old investors and they are bold investors, but there are no old and bold investors. So if you look at the next slide, it explains what I mean here. A lot of the investors in market today try and chase what you call the glory of a shooting star. They want to get outsized return over the next 2 3 years, and they don't realize that a lot of these returns are got at the expense of taking what you call one-time risk, which have very low probability of actually working out. But just because they worked out, firstly, the sustainability of such strategies is a big question mark. But people are excited towards there, and typically they end up being like a shooting star. And this investing style is more like a sprint. Our approach is completely opposite of that. We believe that to create anything meaningful, it takes time, and we believe in the magic of compounding. We believe that once this magic of compounding gets unveiled, that's when the real magic starts. When it slowly starts becoming a big snowball and gathers momentum on its own. And that's what is meant by the magic of compounding. That over 5 7 8 years, the magic of compounding starts working. So we view investing more as a marathon rather than a sprint or a glory of a shooting star. Next. As I mentioned, we try and avoid the extremes. Like when you look at this risk spectrum, the extreme left is defensive, extreme right is offensive. A lot of players, as soon as things look difficult, move towards the left, and when things look rosy, they move towards extreme right. We try and avoid both these because common sense would say that both these is what leads to much of the problem in investing. We try focused and having a right balance between offense and defense at all time, and that's what is our risk positioning thing, where your eyes should be firmly focused on risk, because end of the day, the number one thing which is most important is making sure that the capital preservation is there. Next. This in a way explains, there is this book which talks about ergodicity, and it talks about how in a Russian roulette, investors who play the high risk game don't realize that you getting away with one doesn't mean anything, because if you play the same game more than 2 3 times, your risk of survival is zero. So these are game over kind of situation. So a lot of the strategies which did very well in the last 3 4 years are strategies which are similar to this. They look like huge returns, but the survivability or sustainability of those strategies is very very minimum. These are the kind of strategies one should avoid, because that's where you will see the maximum pain. Next. Lastly, behavioral side, which is conviction cannot be borrowed. So we believe that again, one interesting quote which goes like, choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. So we believe very few people have a focused investing strategy, who think long term, and who are in sync with what an investor wants. And this conviction about doing investing in this particular manner is not something which can be borrowed just because the environment over the next few months will start looking difficult and some of the strategies which worked in last 3 4 years will not work. For us, it's the way of managing money. If you go to the second last, the one after that, I'll try and talk about it. So, this is my last slide, and I think this explains one of the conundrums of investing. We are all aware that, there's this theory of, a perfect market, which says that everything is known to everyone, so you can't make returns. The same way, the modern economic theory talks about how if you want to earn high returns, this is the high return and this is the quality index. Then you have to probably have lower quality. LQ stands for low quality, HQ for high quality. So this is what a typical risk matrix that will be presented to you by an investor, which says that, oh, this is a high risk thing, so you will earn high return, and this is a low risk thing, so your return will be low. So this is what the context is set for investors. But in reality, what happens is that these low quality things is called low quality because these expectations never fructify. You in a way cheat people or try to take make hay out of them by showing them 30 40 returns or suggesting them some superlative returns, but the actual returns are significantly lower or often in negative. This is where you often lose capital. Whereas high quality companies, what happens is that you have a lot of advantages coming in where the actual delivery is far superior than what you expected, because companies keep surprising you on growth, in the optionality they bring in terms of the management quality which is there. And hence, in reality, what happens is high quality, despite low risk, gives higher return versus a low quality. And that is the reason why low quality is called low quality and high quality is called high quality. Because if low quality could give you returns which are better than high quality, then you wouldn't call it low quality in the first place. So with this, I will, kind of wrap up my presentation and summarize it in 2 3 lines again. That we are entering into an environment where I think money making is difficult, and in this context, a portfolio or a strategy like this could do really well. And our strategy is focused on finding 2025 high quality pricing power plays and letting the power of compounding play. Over to you, Aditya. Happy to take any questions that you all have.
Yeah, yeah. So I hope I'm audible. Yeah. So thank you, Siddharth, for the insightful presentation on the fund, which would be and the current strategy in these markets. So if we have any questions, we can see if there are any questions, and kind of we can wait if any questions are there, or we can conclude. So we'll just wait if any questions are coming from the attendees, and yeah. So I think broadly, I don't see any incoming questions immediately.
Sure.
I guess so. I would like to summarize this on 2 points. First of all, just to conclude this. So first of all, we've got a good audience today. So we're thankful for the time, obviously. And what I'd like to conclude it, I think what we summarized in today's presentation is basically, the nuances of the GIFT City IFSC, architecture in India. And as I mentioned to you, that's a great way when you're looking, diversing a global allocation. So I think from an educational perspective, I'm sure that's a great learning for all our audience today. We've also looked at, the current strategy in the markets, and I'm thankful to Ambit Asset Management for your time, for, sharing your ideas. So this is where we can conclude. I think what we'll do is that we would reach out to our audience. We'd kind of share some recording on what we've discussed today. And our teams will reach out to you with a recording of the session, so you can also listen to it and share with your colleagues later. It will also have our coordinates box, whom you can get in touch with in case you want to have further discussions on GIFT City IFSC as a concept or any other related questions. So we're glad to entertain that, and we'll get back to you. So with that, then I would conclude this session. And thank you once again, Siddharth and Ambit Asserin, for your time. I hope
Great.
everyone enjoyed the same.
Absolutely. Thank you so
Great,
much
great.
for giving us this opportunity. Look forward to
Yes, yes. Thank you. All of you have a nice day.
Bye.
Yeah, yeah. Bye.